य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तदेव शुक्रदब्रह्मा तदब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः तस्मिन्
Was a member of SEBI Committee on Disclosure and Accounting Standards. Was a member of Committee for Reforming the Regulatory Environments for Doing Business in India, set up by Government of India. Was invited to the committee set up by Reserve Bank of India to assist in convergence to IFRS by banks. Was a member of Technical Committee to review the form and presentation to the balance sheet of Reserve Bank of India. Served as a member of Insurance Regulatory and Development Authority, Standing Committee on Accounting Issues. Was a special invited National Advisory Committee on Accounting Standards. When coming to industry bodies, he was on the Confederation of Indian Industry (CII) and he was a member of National Council, Committee of Financial Reporting, CFO Forum, Committee on Corporate Governance and Committee on Regulatory Affairs. Was a member of National Executive Committee of the Federation of Indian Chambers of Commerce and Industry. Member of High Risk Task Force set up by FICCI and Global Risk Initiative. He was the past president of the Bombay Chamber of Commerce and Industries, India's oldest chamber of commerce. With related professional bodies, he was a member of Accounting Standard Board, Vision and Restructuring Committee, and Accounting Practices Committees in various committees of ICI. He was a member of Secretarial Standard Boards constituted by the Institute of Company Secretaries of India. He has lectured extensively in India of all the professional bodies like ICI, Institute of Internal Auditors, RBI, CII, SEBI, IMF, and other bodies, and also he has been abroad and delivered lectures on various subjects. He has served clients in manufacturing, banking, financial services, technology, media, telecommunication, energy, resources, and consumer business sectors throughout his professional career. Sir also is an academician. He has co-authored publications by CHH titled IGAP, book on IFRS. He is a member of Board of Studies and Faculty of Commerce on Osmania University. He was a member of many committees of ICI. He is empaneled expert of IFRS with the International Monetary Fund. He is the chairman of the Insolvency Research Fund. He is on Executive Committee of Indian Accounting Association for Education and Research and also served as Vice President of Large of IIAER. Ramesh sir is a director on several listed companies and listed companies in India. So just few words, I request Ramesh sir to enlighten us audience on the Schedule 3 amendments and Kara 2022.
CA Deepak Ladda, CA Toshniwal, CA Reddy, some very good friends in the hall here, Pankaj, ladies and gentlemen. Good morning to all of you. I'm truly delighted to be back in Hyderabad speaking at a program. I know, and particularly physically, I've spoken online, but it's not the same as physical, and that's why I am also as delighted as you are in being able to see faces physically and speak. Though I keep wondering why Hyderabad branch picked an old man to speak on a topic like Caro and Schedule 3, and you've had a great first day, and suddenly this may be a dampener to some extent. The reason why I'm saying that this may be a dampener is because of the very fact that Caro 2020, we are talking in 2022, it got deferred because the profession was deeply concerned. Caro in different forms has been there. I'll take you through all of it. Schedule 3, there have been changes. For the first time, we have seen Caro and Schedule 3 being changed at the same time. The reason being, as a profession, we were always complaining, saying that you are asking the auditors to report on certain matters, but there is no obligation on the management to report on those matters or provide the information. So as a first step, what the government has done is amended Schedule 3 so that there is a reporting by the companies, but equally there is a responsibility on the auditors. Once it's in the financial statements, you are responsible. And now additionally, it is in the report. And I'll take you through some of the important ones. I won't take you through the whole of Caro or the whole of Schedule 3 because I'll take you through what's new. But before I take you through, it's important to understand what the environment is today. The environment today, particularly for those carrying out audits, is not pleasant. It may not be exciting. I have been doing this for more than 40 years and I have seen the transformation. I have seen the challenges which currently everybody is facing. It's not about the size of the practice. It is not about loss of opportunities for work. Those are different matters which I think you spent a lot of time yesterday. It is about the risks which have emerged as a result of being in practice and particularly in the attest function. The risks have dramatically increased. Why have they dramatically increased? In recent times, we have seen a large number of corporate failures. We've seen some of the largest financial services companies failing. One of the large banks almost failed. Thousands of crores were lost. The offenders left India. And then who is left facing the music? The profession. Largely because they have signed off on the financial statements. Whenever anything goes wrong, there is definitely a question asked about the profession. But it doesn't stop at the question being asked because the investigative authorities go after those who have signed the financial statements. And look at it this way. You can, and today now I am a director in several companies and I am not in practice. I can see it from a different lens. As a director, and I've said this before NFRA, as a director you spend maybe 50 to 75 hours spread over 8 meetings, 6 to 8 meetings in a year and look at PowerPoints. So you are expected to be accountable. Is that the right model? At the same time, who's inside the company for numbers of days with a team? It's the auditor. If he is not able to spot, how do you expect directors to be able to spot? Is a question which the director community has been asking also. So there is a realization today that an auditor is inside the company with teams. And the question which is being asked is, has the profession lost its eyesight? Are you not able to see what needs to be seen? Is it with your sampling methodology? Is it with the quality of the people you're doing it? Is it your inability to interpret the documents which come before you? Or is it the areas you've selected for examination? So are you so blind that you are not able to see corporate frauds, corporate failures, big, small, doesn't matter? If you read today's newspaper, you will find that the Institute of Chartered Accountants is going after a large number of chartered accountants who have signed off on all those shell companies which were formed for the loan frauds, the Chinese loan frauds. Behind every such shell company, there is a professional, be it a company secretary or be it a chartered accountant. And then we also had 300,000 companies which were struck off. And because transactions were happening, and strangely you will find that is there in Schedule 3 also, whether a question has to be asked, it has been asked and you have to answer, whether there is a transaction which struck off companies. Why is even that happening? That means the company is struck off from the registrar of companies records, but the company's bank accounts continue and people are transacting through it and there are professionals signing off. That's the reality. Added to that, with all these failures, you would see today's any day's paper you pick up. It is all about CBI, Enforcement Directorate, Prevention of Money Laundering, NFRA. Name the investigating agency that is there. It's about when there is a bank loan default, the bank immediately, nationalized banks refer it to CBI. And the professional who has signed off on the financial statements is accountable. He's called. And it's going now beyond the signing person, it's going into the teams. People who are called. And I'm aware of the fact that the government is looking at to see how can we amend the law, including the law relating to National Financial Reporting Authority, to ensure that members of the audit team are held accountable in addition to members who are signing off. Because the fault is not only of the person signing, he may be ultimately responsible. There is a team which is participating in the audit. So the question is never when you do an audit. It is not just about what documentation. There is a huge shift in accountability and responsibility today which was never there before because of the manner in which the investigative agencies are taking matters. And I didn't mention the other major investigating agency, which is the SFIO, the Serious Frauds Investigating Office, all under the Companies Act. So it doesn't matter, as I said, whether it's a big or a small company. You're a small company, you sign off, it defaults on a bank loan, you're before the CBI and the accounts are shown. Whether it's diversion of funds, whatever it is. And the Prevention of Money Laundering Act, if you read the Act and the annexures, any loan which is given to a related entity, private party, is deemed as siphoning off and then you are investigated. And then additionally, you have the National Financial Reporting Authority. Its initial reports have been more like an investigation, and the language which is used, which is not even used by the investigating agencies in the report, so strong critical language. And they are hyperactive now. So earlier it was only the Institute of Chartered Accountants which we had to worry about. Now you have the NFI. This is the scenario. And this is the scenario in which you need to look at CARO 2020 and look at Schedule 3. Don't take it lightly because you would have signed off on each of these clauses. It's not enough that you have documentation to support this. You should be able to answer why you reported in a certain manner or why you did not find some things. And I'll take you through some of the critical ones which are worrisome. I have been part of CARO formulation, whether it's CARO 2020 or CARO 2016 or CARO 2015, and I have been part of the entire drafting of this CARO 2020, and I know the mindset, I have seen the mindset of the government at very close quarters. This itself is a condensed version of what should have been there. That was the scenario in which CARO 2020 was framed, because at that time the credibility of the profession was at its lowest, at a nadir. And government said, we want the profession, if you want the profession to be there, we want the profession to tell us on many matters which we are today seeing before registrars of companies, before investigative agencies, which is what they have incorporated. So if you really see how it evolved, and you see the big changes. It started in 1975 when it was Mao CARO, then it went on to 1988 when it was, many more clauses were added. That time I know people in the profession used to derisively call it Mar CARO instead of Mao CARO. And then it went on to CARO where people said it is CARO now, there is no forget Mar CARO, you've already been beaten up, now you have to do. And that's how it went on to CARO 2003. Then after the new Companies Act came in, and I was again party to CARO, we truncated the CARO because we felt there are many matters in CARO which need not be reported. For instance, whether the company is making cash losses. And it's evident from the financial statement. Why should an auditor tell you whether a company is making cash losses? So we dropped those clauses, but it has come back again because government still wants, saying, no, we want to know if it's making cash losses. I said it is evident. They said, so what if it is evident? We want the auditor to say so. So we did. And then we came on to the most recent Caro 2020. So what were the broad principles? The first is, there was a feeling, and there continues to be a feeling, that auditing standards allow a lot of judgment. Auditing standards tell you that you have to decide what to check, how to check, when to check, where to check, all of it, collect evidence, do your own analysis. Nobody can, question your judgment really, unless you've been grossly negligent. So, for instance, financial statements. Nowhere in the auditing standard does it say you check fixed assets, current assets, everything, or share capital. Nowhere does it say every item of expense to do. You may have materiality. You may have other considerations where you feel the risks in certain elements of the financial statements are higher. You may focus on those. And then there is the auditing standard on sampling, there is an auditing standard of consideration of fraud, compliance with regulations, going concern, a whole host of auditing standards. There was a feeling that we need the auditors to look at certain matters, irrespective of what the nature of the entity is, and report on those matters. That is principle number one in Caro in general. Principle number two is they want the auditors to say, yes, we have carried out A, B, C, D procedures, though they are required to do those procedures under the auditing standards. But the moment you say, I have done this, tomorrow you can be held accountable. You can't then say, no, I did not do so. For instance, inventory verification. For instance, fixed verification of fixed assets. There are many I'll come to those. You can't then say, I did not do, because you are reporting what it is. Then, we've seen Caro over the years. There's a diversity in reporting. Particularly the clauses relating to defaults on borrowings were there for a long time. People used to write generally regular. Some would say there are some defaults. The report is not evaluative. So finally we decided, let's give a format. So once you provide a format, everybody has to fill in the format, and you will find in Caro 2020 there are formats. So you're stuck with the format and you have to provide the details. You can't then get away from that. Additionally, a lot of recommendations came from the registrars of companies, RBI, and SEBI also participated in the discussions. Also, there are a lot of newer expectations which came up, and as a result of it, what happened was, we had Caro 2020, where you have 21 clauses, but don't get mistaken by the 21 clauses. Those are broad clauses, of which 11 were modified, 4 were the same continuing ones, 5 new clauses, and 2 were reintroduced from Caro 2003 and 2015. Only 1 was removed because it was already in the main body of the auditor's report. So, what are the new clauses? You will see there is a clause on transactions not recorded in the books. Internal audit was reintroduced from 2003. Cash losses, I said it's irrelevant, but it's reintroduced from 2003 and 2015. Statutory auditor resignations was rampant, so there was a question about we must have something in Caro on statutory auditor resignations, so we put in 1 clause there. I'll talk about that. And a dangerous clause on ability of the company to meet its liabilities, because companies were defaulting. So the question is, why can't we have the auditor say whether the company can pay its liabilities? This is a judgment call. So lots of debate happened. To be fair, the professional body resisted a lot. They said, how can we be held accountable for running the business? Somebody will default in the next 1 year. I don't know. What did finally emerge? He said, you have a standard of going concern. That standard requires you to look 1 year ahead and form a view as to whether that entity will continue. So all what we are asking is, you are the expert. You can read a balance sheet. You can look at the ratios. You have access to board minutes. You have access to management plans which you see as part of it. You know the commitments. You know what is current liability, what is non-current. You should be in a position to say whether in your view anything has come to your attention that the company is not able to meet its liabilities. Nobody is holding you accountable if tomorrow there is a default. But the question is, were those signals there? Can't you read the signals and tell it? Otherwise, what for is your audit? If you can't interpret a balance sheet, whom do you expect to interpret a balance sheet? And that's a very important one. And then there are new clauses on CSR, etc., and one clause on consolidated financial statements. But if you really look at these 21, there are sub-clauses. And if you look at the final position, there are actually on a total in CARO 2020, there are 47 sub-clauses. So there are 47 matters on which you are reporting, which all there are some consolidation, some changes. So you will find there are 28 new additions, not the number which I said earlier about 11 new additions. Then there are significantly new sub-clauses which are there in it. So let's take what's new, what is potent in all of it. And then, as I mentioned to you, we said Schedule 3 should also be amended. Why should an auditor be required? So if you look at this mapping of CARO with Schedule 3, you will find in a number of cases, there is already a reporting by the company now on the same matter. So you have to, in any case, verify, and so it should be possible for you to report it. But let's focus on what is very critical. And I've listed this. These slides can be shared also, that's not an issue. But when you read, I'll take you when I take you clause by clause. The first one is in property, plant and equipment. What has changed here? Earlier term was fixed assets. The accounting standard now uses property, plant and equipment. So that's one in language change. More importantly, there was this clause on physical verification, which continues the way it is. Clause on maintenance of records, which continues, but now it has been added. Intangible assets have also been added in addition to tangible assets, which is property, plant and equipment. Then there was this clause on title deeds, whether they were in the name of the company. It was already there. Now a format has been provided, which says in whose name it has been held, whether the person is the promoter, whether what period has the title deed not been in the name of the company, is there a dispute. So a lot more information is coming into the auditor's report through this reporting, which is very useful information for any reader. So you can't just say 10 title deeds are not in the name of the company. You have to say why. And in whose name it is. If it is in the name of the promoter, then even more worrisome. And if it is in the name of the promoter for the last 10 years, then it begs the question, why is it that the asset is in the company's books, but the title is not in the company's name? And why for so many years? That also you have to state now. Then another clause got added. This is a very interesting clause. It's a clause on whether there have been any proceedings, whether any proceedings have been initiated or are pending against the company for holding any Benami property under the Benami Transactions Prohibition Act, which actually is called the Prohibition of Benami Transactions Act, and rules made thereunder, and if so, whether the company has appropriately disclosed the details in the financial statement. So Schedule 3 has also been amended. What does this imply? If part of the proceedings, it is alleged that the company is holding Benami property, then it raises questions as to compliance with accounting standards, who paid for the consideration, where is the property, why is the company holding the money. Or if the allegations are that the company's properties are held by somebody else, then the same set of questions come up or related questions come up. So it is not, whilst Kara reporting may be on whether proceedings have been initiated, when you are saying yes, there are proceedings initiated, the hidden question there is, have you seen those proceedings? Have you understood the implications of those proceedings? Have you dealt with the implications of the proceedings whilst you are signing off in your financial statements? There is a silent implication there or a hidden implication which you need to consider. So this is a very important one which is new under property, plant and equipment. Then physical verification, whether it reasonably interprets all this, don't have to worry about. These are old clauses. As I talked to you about title deeds I've spoken about. Then whether the company has revalued property, plant and equipment. The only difference now is that if your revaluation is greater than 10%, you need to state. That applies only if you are on a revaluation model and not on a cost model. As you know, in a revaluation model, once you are on that model, every year you have to revalue. This is only asking factual information as to whether it is greater than 10%, in which case you report. But it doesn't take away your responsibility of verifying the valuation, whether registered value has been deployed, all of those requirements are there. Then inventory, the change in inventory is again only on whether the difference in inventory is more than 10% in a particular class, then you have to report. But under that inventory, paragraph 3(2)(b) is a very important paragraph. That got introduced and we had a lot of debate on this. What does that paragraph read? Whether during any point of time of the year, the company has been sanctioned, not drawn, sanctioned working capital limits in excess of 5 crores. Any point in time. In aggregate, in 10 limits of 20, 25 lakhs or 50 lakhs or whatever, from banks or financial institutions on the basis of security of current assets. If that has happened, then whether the quarterly returns or statements filed by the company with such banks and financial institutions are in agreement with the books of account. Now this has been incorporated in Schedule 3 also, but the point, why did it happen? Because in bank audits, I understand why bank audits, in banks when defaults were happening, all of it, they found that the monthly returns, what is the term, whilst the term used is quarterly, if the returns are monthly, say April, May and June, you are required to verify June month return. What used to happen, and all these horror stories came out in the course of discussions. What used to happen? Companies would file a statement as of 28th of March and show inventory of say 10 crores. March 31st inventory would be only 1 crore. And the total turnover of the company would be 4 crores. So where did it disappear? They would have filed 10 crores to the bank for drawing working capital so that limits don't disappear and drawing power remains intact. But when the final accounts are presented, it is 1 crore inventory. Turnover, you see, it is 4 crores. So no relation. And during the year, even more horror stories of inventory, receivables. So current assets had no relationship with the books. So the banking community was livid. They said, shouldn't the auditors check this? We argued as an audit profession, this has got nothing to do with true and fair. My job is to report on the true and fair of the balance sheet and profit loss account, and the balance sheet and profit loss account are true and fair. How does it matter what the company has done in filing something with the bank? Why should I be concerned? My auditing standards don't require me to look at it. is what the profession said. But general feeling was, so what? We will ask you to verify through Caro. And that is why in Caro 2020 this clause got included. Initially they wanted all returns to be verified. We said, you realize the volume if it has to be all returns every month, and many companies, even the monthly books of accounts are not there, monthly inventory is not there, monthly receivables, we don't know. And in some cases, work in progress, how will you determine monthly? So this, when you talk of current assets and inventory, it's not just raw material or finished goods. It includes goods in transit, it includes work in progress. So how are you going to verify this? It's a huge responsibility. So final compromise is quarterly. They said this is, and it has to be coterminous with that date. If they have not filed, they're filing as of March 28th, fine, you look at the books as of March 28th and tell us whether it is an agreement with the books. But the point is it has to be an agreement with the books. The only concession, but it's only a concession which has no value, is that you're not expected to audit the return, nor are you expected to audit the monthly numbers. But, as I give you an example, if last month inventory is 10 crores, this month inventory is 1 crore, and there is no turnover, then obviously you need to ask yourself, where did it go? You can't say, I didn't audit 10 crores, I'm only auditing 1 crore. It raises serious issues on internal control and internal control over financial reporting, a whole host of changes are there. This is a very, very important clause. Clause 3.2b in Caro reporting, and God forbid, auditors who don't look at banks, their returns filed with banks. And this returns filed with banks has implications on the business. I understand that when a company files a return with banks, their drawing power is influenced by that. But now, this is really, stirred a hornet's nest in a way. It's really a challenge. So the rest in inventory is not so serious, and when we come to the point on loans, investments, guarantees, this clause 3.3 is again a very dangerous clause. 3.3 A, B, C, D, E, F, they're all grouped with subclauses, and I'll go through each of the subclauses. And I'll tell you where the problems are. This is a core which has come through arising out of all the failures in the financial services sector, and we definitely have to be far more vigilant, no doubt, but the challenges, it's easy to say be vigilant, but what does one actually do? And this is where this whole issue of should forensic get involved in audit, how should audit be done, that's a completely different subject, and I think we need to have sessions on what is the expectation and what needs to be done. And there is a lot of discussion which is happening, including at an NFRA level, and I think we need to have serious dialogue on audit quality and what needs to be done. Forget all the measures of audit quality which Institute had come up with. That is not the issue. The core issue is the ability to see and the ability to smell something wrong. How do we develop that and how do we incorporate that? But beyond ability to see and ability to smell, you've now been given your ability to think and evaluate is being put into question through this clause. The first one, 3.2a, is a very simple clause which more information as to whether during the year the company has provided loans or provided advances in the nature of loans. Now this was the term advances in the nature of loans which was there in the earlier Caro got dropped subsequently. It's been brought back. Because what is an advance in the nature of a loan? I give an advance for raw material purchase of 10 crores. and my raw material purchases are only 1 crore every year. Isn't that 9 crores extra in advance in the nature of a loan? It is. You can't say, no, that's not a loan, it's an advance, and get away from it. So that's also captured through this. So whether during the year, so you have to evaluate, is that advance an advance in the nature of a loan? Given the size, given the period for which it is given, the supply, is it normal business practice to give such an advance at all? To whom it is being given, for what purpose it is given, all of these now get captured through this clause, though it seems innocuous. The first clause is more collecting data, whether during the year the company has provided loans or provided advances in the nature of loans, or should guarantee or provided security to any other entity, whether you have provided guarantee or security. Of course, if you are in the business of giving loans, this clause does not apply. So, if you are not in the business of giving loans, it asks for information how much of the loans, aggregate amount and balance outstanding to subsidiaries, joint ventures, etc., and how much to all other parties. Okay. B, which is the most important clause. It asks the question whether the investments made, the guarantees provided, the security given, and the terms and conditions and grant of all loans and advances, in the nature of loans, and guarantees provided are not prejudicial to the company's interests. You have to take a view when a loan is granted, when an investment is made, the terms thereof, whether it is prejudicial to the company's interests. No, I am a manufacturing company. I lend money to another company. I am not in the business of lending. So, instinctively, if I am not in the business of lending, isn't my lending to another entity when I am in the business of manufacturing prejudicial to the interests of the company? Is a question which you will be asked. Then comes the terms, etc. So the rationale for providing a security, for giving a guarantee, for giving a loan, you have to say it is not prejudicial to the interests of the company. You should have enough data to evaluate, you should have formed an opinion, and that should be so convincing because 3 years, 5 years later something happens, you will be caught. The investigative agency will take the view it is prejudicial because tomorrow that loan doesn't get repaid, something has happened, he said this was prejudicial from very day one. That company has got losses, that company is insignificant. Because many cases, loans were given to shell companies. Now when you are giving loan to a shell company, that company has no substance, that's why it's called a shell company. Would you give your money to a bankrupt person? No. So fundamentally, this is prejudicial to the interests of the company. So this clause, 3.3b, mind you in Karo, if you are giving clean reports all the time, you need to be extremely careful on this particular clause. Then you have para 3c, where the loans principal have been repaid as stipulated, where the receipts are regular, and what is over 90 days in para 3d. The problem here is not in this paragraphs. It is in the Institute Guidance Note. If you see the Institute Guidance Note, they have given, and this applies to all entities. It doesn't apply only to those not in the business of giving loans. It applies to all entities. Only para 3.3a is not applicable to entities whose principal business is of giving loans. Now, the Institute Guidance says, provides a format, name of the entity, amount outstanding, amount payments in the irregular number of days. If you are an NBFC, there will be thousands of car loans, scooter loans not paid. Are you going to give a list? Then thousands of it? I don't think you can. I don't think that is expected. They are not even asked you. But the institute has given a format, guidance note. So tomorrow you are answerable to ICR saying we have given a format of whether loans are repayments or receipts are regular. This is what it is. That's the only challenge here. And then, if you are not provided for any schedule of payment, then you have evergreening, which is para 3.3e. There's been a lot of, you've heard this term evergreening in the banking sector, in the financial services sector, big time. You have a loan, it is about to be defaulted, so you give another loan, you repay this loan. Or you repay interest so that it never becomes an NPA. That is evergreening. Now they are asking information. Whether any loan or advance in the nature of loan granted which has fallen due during the year has been renewed or extended or fresh loan granted to settle overdues of the existing loans to the same parties. It doesn't matter to whom you have given the loan or advance. If it is used to settle existing loans to the same parties, if so specify the aggregate amount of such dues renewed or extended or settled by fresh loans and the percentage thereof to the total loans granted or during the year. Of course, for those companies whose businesses of loans this does not apply, but the question is, this evergreening, you can't no longer say I'll extend beyond a default date, you have to still report it. And then when you report, you have to evaluate. The last one, look at that. Whether a company has granted any loans in the nature of loans repayable on demand without specifying terms or period of repayment. This is very common. It is not overdue because you have not called for it. It is payable when I call for it. Now the government says, all right, you give us the data. You tell us how many loans are there without payment schedule. Report that. And then you see the challenge which will happen. Then your next question is it prejudicial? You never called for it, but you are borrowing more and more money from banks. Here you have given a loan which is lower rate of interest than what you are paying to the banks. Why are you borrowing more from banks? Isn't this giving of this loan prejudicial to the interest of the company? The answer is yes. It's a challenge. And then we go on to the next one. The next one is 3.4. Okay, I'll take it. This was there before also in a way. Whether loans, investments, guarantees are in compliance with Section 185 and 186 of the Act. 3.5 is in deposits, which was there before. Maintenance of cost records was there before. I won't take you through that. So let's get on to something which is new and which is more potent. Deposit of statutory liabilities was there, an old clause. And the same, only, the language has been changed to say add GST and things like that, which was not there in the earlier Caro in 2016 was there. 3.8, look at this, and Ajay is the expert on this. Whether any transactions not recorded in the books of account have been surrendered or disclosed as income during the year in tax assessments under the Income Tax Act 1961. If so, whether previously unrecorded income has been properly recorded in the books of account during the year. What is the philosophy in this? The philosophy is, if you say, yeah, this is my undisclosed income, and you accept it and then you pay tax on it. Let's say 100 rupees is undisclosed income, and you pay tax thereafter, whatever it is, let's say 60 rupees. I'm not getting into debate on what is penalty, what is tax, etc. And then you fine everything. The simple question is, 100 rupees was undisclosed income, so there is an undisclosed asset of 100 rupees. And you have paid 60 now, so there is still 40 undisclosed asset. Why shouldn't that be brought into the books? So what does this say? By asking this question, has it been properly recorded in the books? So if there is undisclosed income which has been voluntarily surrendered or accepted, it is not just about paying taxes. It is about bringing that asset back into the books, recording that income, whether it is recording income and expense or income and asset, the double entry has to come into the books. And here, the view which the institute has taken, perhaps rightly, because you could extend this argument to say, in an assessment there is additions which are made. Out of frustration, you accept the addition, you say fine, I'll pay tax and go on. The question is it undisclosed income, is it income surrendered, or as the term used here, disclosed? The answer is, the institute has taken a view that that is not so. You could have in the course of assessments, you may accept an addition and move along, and you don't have to report under this clause. And therefore the question of accounting for an income, because many times the department may take a view, it may become a matter of opinion as to whether that income, and a lot can happen even in transfer pricing issues. And that is where this thing also could crop up. Then the rest is on statutory dues. This is not important. Default in repayment of borrowings. Whether the company is defaulted in repayment of loans or borrowings or payment of interest, now there is a format. Whether it's been declared a willful defaulter by the bank, you have to report. Whether term loans have been applied for the purpose for which the loans are obtained. If not, the amount of loans so diverted and the purpose for which it may be used should be reported. Diversions. This is a big issue with all enforcement directorate, SFIO, diversion. Now you have to report on diversions. You have to take a view and then say what purpose. It was borrowed for this purpose, or money was raised for this purpose, not applied for this purpose but applied for some other purpose, and you have to report. These may seem innocuous, but put it in the context of the entire environment of investigations which is happening today. Entire environment. And it will crop up a few years down the road. The person who did the audit, your staff would have also gone. And you will sign the accounts, will be accountable. And it is, then there are two clauses which came in, 2 or 3 which have come in, which are related, which all arose because of the financial services entities which failed. Saying here is a parent which raises money. That parent raises money for the benefit of some ultimate subsidiary, gives it to an intermediary, that intermediary gives it to the subsidiary. So the question which is being asked here is, have you raised any money from any person on account of or to pay the obligation of your associate, your subsidiary, your joint venture, etc. Please report. Because when there are multiple layers, this question is always there, who has raised. What used to happen was, and this is where the concern is, parent would borrow the money. So it's a borrowing in the parent's books. Parent has invested as equity or in a subsidiary. That subsidiary in turn has invested in equity in another subsidiary. The last subsidiary has gone bust. So that equity value is 0. The intermediate entity equity value is 0. Parent defaults in the loan because all this whole chain is bust. But when you look at each of these, it's all equity. So the question therefore is, did you borrow to lend for others, to invest in others? If so, they want that information. Details of money raised with description of the transactions and the amount in each case. And that is the information which is there. And if there has been default on repayment of the loans, even that has to be reported. So then let's get on to one or two other important clauses. Similarly, if you have raised loans on the pledge of securities held in subsidiaries, joint ventures, etc. Okay. Then IPO monies utilization, which is there as part of the listing requirements, etc. We don't have to worry about. let's get on to where there has been a serious debate, fraud. Earlier it was whether any fraud by or the company by its officers or employees. Now the word officers or employees has been removed. Whether any fraud by the company or any fraud on the company has been noticed or reported. So it captures that whole subject matter of fraud. And if you see section 447 of the Companies Act and see the definition of fraud, you'll ask whether there is anything which is not a fraud, because it's so wide. Whether there has been monetary loss or not, please read that section, you'll realize what implications it has. The second clause in this is whether any report under section 143(12) has been filed by the auditors in form ADT4. Last one has been a subject matter of a lot of debate. Whether the auditor has considered any whistleblower complaints, if any, received during the year. Now you could have two sorts of situations. You could have situations of listed companies who are required to have a whistleblower mechanism and a process in place. You could have other companies where there is no requirement to have a whistleblower mechanism, but complaints come. That complaint is also a whistleblower. See, if you see CARO applies to virtually all companies, barring some small private companies and one-man companies, then you are required to, if you are required to ask, you are required to be made aware of whistleblower complaints, and have you considered that complaint in carrying out your audit? If that whistleblower complaint says inventories are fudged, this is it, you have to be careful about that. This is a big job for auditors which they have to now look at it. And this has raised, there's a lot of debate around this, but I think this finally audit says, have you considered? We are not asking you to investigate every whistleblower complaint. Compliance with the related party transactions, I won't get into all this. But internal audit system, whether it's commensurate with the size and nature, all that is there. The other requirement which is new is whether you have considered the report of the internal auditors. You can't just say, I have not read the internal auditor's report. Have you factored that in your audit? That's all it says. Whether you have considered means have you really considered the report. Non-cash transactions have been there, registration with RBI, nothing much in all this. There is the last one, core investment company, nothing here. And company, whether it is incurred cash losses, not important. Whether during the year there has been any resignation of statutory auditors. If yes, well, the incoming auditor, has he considered the objections, issues or concerns raised by the outgoing auditor? Let's say you got appointed in the middle of the year, or you got appointed middle of the term. Whether the outgoing auditor has raised any objections, conveyed, there is a professional requirement to convey, no doubt. But if besides that also, if you are aware of any issues, concerns, objections, have you factored that in your audit? That's the broad question, because this whole issue of resignation has been, the auditors are resigning when they are seeing there is a problem. So the question is, and in many cases you would have complained about the problem also, nothing is being done, so he's resigned and what. Because the question is, why should an auditor resign? I also believe an auditor is free to walk out. Wouldn't you walk away from a risk? You would. Why should you continue? Anyway, that is a different subject. This is the last of the potent clauses. On the basis of financial ratios, which is now provided in Schedule 3, aging and expected dates of realization of financial assets. You've seen the aging, you know the aging of receivables, aging of payables, you know the aging of fixed assets, aging of capital work in progress, and other information accompanying the financial statements, meaning the notes, etc., management discussion and analysis, directors' reports, the auditor's knowledge of board of directors and management plans, based on what he reads in the minutes, whether the auditor is of the opinion that no material uncertainty exists as on the date of the audit report, that the company is capable of meeting its liabilities existing on that date of the balance sheet as and when they fall due within the period of the next 1 year. This is a very, very important. You have to sit at the end and see is it likely that the company will default on its liabilities? What are those liabilities? What are the due dates? What are the due dates of receivables? What are the due dates of current assets? What's likely to be made in terms of profits or losses? All the ratios which you are seeing. This is, you can say, argue about this, but if you read your standard on going concern, auditing standard on going concern, it has almost similar language. And that is where now it is brought into Caro, and this is a very, very important thing. The last one is, of course, there are ratios that have been incorporated in Schedule 3. A lot of ratios have been there, which have now been incorporated in Schedule 3. So you can't say, I don't know about the ratios. You are yourself certifying these ratios. And you have to understand what are the implications of these ratios. CSR funds, there are some requirements here in Caro. Those are more compliance-related requirements. And the last is on consolidation. If you are signing the consolidated accounts, Caro does not apply to consolidated accounts, but in the consolidated accounts, the only requirement is what are those subsidiaries where the auditors of those subsidiaries, associates, joint ventures have had an adverse comment, which clause and how many of them. That is the only requirement. So that's insofar as Caro 2020. In Schedule 3, as I gave you the map, most of it is mapped into Schedule 3. Additionally, what Schedule 3 has done is they have asked for agings. There's a lot of aging which is asked for. Let's say aging of, in this case, receivables. Earlier it used to be over and under 6 months. Now it is less than 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, more than 3 years. Within that, what is disputed, secured, unsecured already was there in a way. Similar requirements are there for trade payables. Similar requirements are there for fixed assets, capital work in progress. And if you look at capital work in progress, it talks of projects in progress, projects temporarily suspended. You have to give the aging for all of those. And you have to give an aging if it's when is it likely to be completed also. So that is something which, because what used to happen, a lot of fraud used to be tucked away into capital work in progress. And then nobody really looks at capital work in progress, they look at loans, advances, etc. Through this aging, even that gets caught in a way. And you can't say, no impairment, it is still in progress, it is you have to say expected date of completion. So and if you're capitalizing interest, then even more a challenge. So that is also being incorporated. Barring that, the rest revaluations, all those are part of Caro which got incorporated. There are some cosmetic changes relating to standards in the Act. So I think with this, I'll be happy to take questions. There's a lot in my presentation deck, but those are all technical in relation to cosmetic changes in profit loss account or balance sheet, etc. In Division 1, Division 2. So, back again, as I said, if you think this is simple, then I think we need to be worried about it. But if you think it is complex and worrisome, then you're in the right frame of mind. Yeah. Free to ask questions. That might work.
Anybody has any questions or would like to have some details or clarification?
Regarding the undisclosed income, there are many problems with that, particularly in certain circumstances. These directors give an undertaking and say that they will show X amount of income this year. And they come and pass an entry in the books of accounts, creating income and debiting a fictitious asset. And after 4 years, they realize that it has to be written back again. The problem with this is an asset which is not realizable at the first instance. Or else they will have to bring in cash. The point I am trying to say, as an auditor, first of all, asking somebody to pass an entry for these kind of incomes, undisclosed incomes, is a big headache.
Why do you say undisclosed income?
Because under any of these proceedings, search proceedings or survey proceedings, These people give a declaration that they will disclose X amount of income and come and pass the entries in the books of accounts.
So they're passing the entry in the books.
Yeah.
So it's not undisclosed income.
No, the point
It is not unrecorded income. It is recorded income but fictitious.
yeah.
That is, so that's a fraudulent entity.
Originally, before passing this entry, it was undisclosed. To disclose it, I passed this system. See, there is a travels from being undisclosed to recorded income.
Have the class would be useful.
Yeah.
You want to go back to the class?
I think that's
The amount of responsibility upon the auditors to report or not to report and if report, what to report becomes highly debatable issue and a kind of an onerous responsibility on us. So I somehow some of these occasions when these amounts are brought into books of accounts, first of all, if they are not brought into the books of accounts is one challenge, and if they are brought in this manner, this is another challenge.
class 8.
8, yes, sorry. Correct. No, but I'm still not clear as to why you are saying undisclosed income. This not, is it going back or going front? I'm not able to.
No, then let me rephrase
Yeah.
my question, sir.
So rephrase your question.
Yeah.
It's got stuck here.
The reason I'm saying is,
Yeah.
there is a disclosure made under section 132(4) of the Income Tax Act. That's when an admission made and a disclosure is made. There is undisclosed income. And that undisclosed income is recorded in
Sorry,
the books
it
of
is frozen, system is frozen. But don't worry, we know the clause in a way. Yeah.
Then, once a declaration is given,
Can you
then it
go
is
back?
brought into the books of accounts. Then it is brought into the books of accounts.
Yeah, but I'm still not clear. Ajay, did you get the gist of what you're
Ajay,
saying?
please add.
Ajay, maybe.
I have not blocked the time of other participants, but I have not blocked the time of other participants. They may have more questions.
No, it doesn't matter, but you can provide a perspective on what he's going to say.
What Mr. Subramanian is saying is that
If you have disclosed income,
yes,
obviously there is a corresponding asset.
yeah, exactly that's what I wanted to react. Exactly that's what I wanted to react.
Ajay, 1 minute.
Therefore, that double entry has to be.
No, Ajay, 1 minute. If you bring that income into books of accounts, it gives rise to fictitious income in the books or a fictitious asset.
Correct, there's still a double entry which is fictitious.
Yeah, which itself is then
I just want to add only 2 lines to that.
Yeah.
I think the undisclosed income or undisclosed asset is not as simple as the question is there in the academy. Because in income tax, when we say undisclosed income, it includes expenditure, as you also pointed out, disallowances, etc., etc. It's not that all the time you have an asset which needs to be brought into the books.
Understood.
That's all. There may be another transaction which, in fact, many companies do not account for the transaction for the simple reason that if you make an entry in the books of accounts, it initiates penalty under the Income Tax Act. It makes the penalty automatic almost. So in most of situations, it's not accounted. So therefore, I think that the question requires proper understanding of the income tax issues of that. It's not a mere double entry which to make the books of accounts.
No,
that's why
I understand the income tax
The
act has its
language
complexities.
unrecorded.
Pardon?
Language employed there is unrecorded,
Correct.
not undisclosed. Unrecorded is to be recorded. Necessary provisions of expenditures.
So
of tax
essentially what it says
unrecorded
is,
and
if you have,
unrecorded is the language employed there.
it
It
says,
contains a number of penalties, maybe more than the income also. They have to record
possible.
all these.
All it says is, first is income, first we have to accept, forget the fraudulent income. There is genuine income which is unrecorded, which you have not recorded, but you have surrendered or voluntarily disclosed. Yes, I have not recorded this. Then this question is, fine, now you recorded. You have yourself accepted you have not recorded, right? and you have disclosed that income or surrendered that income. Is there any complexity in that?
I don't persist. Just only one point. Most of the time when we surrender, we don't surrender like simply like you say that I had unaccounted income or asset and surrendering it. 99% out of 100 times in the income tax act when I surrender, I would say this is not my income, this is not my unaccounted expenditure, everything is fine. Still, I'm giving it up for the purpose of settling a litigation.
That institute has already said,
Yes.
if that you are doing, it is not covered by it. In the guidance note.
Exactly.
Thankfully, in the guidance note, they have provided that. But still, this becomes a subject matter of the litigation with the investigative authorities tomorrow when things go wrong. Yeah. Any other questions?
Sir, I have a...
Yeah, Ramanamurthy. Yeah. You, who else has got?
Yes, Ramanamurthy, please go ahead.
Another related point.
Sir, good morning. Very glad to hear you after a long period in person. Question is, see, as an auditor, our report is to shareholders. That is the very intention of the audit process. By virtue of government rights, it is bringing in various stakeholders' expectations into the financial statements, either by way of disclosures or in the audit report.
Correct.
While I understand that the institute is making every effort to see that guidance is given and some kind of balance is made out from the regulatory perspective and the reporting obligation of auditors, don't you think that the quality of financials is getting suffered by clouding the information which are trivial in nature? For example, I tell you, if a crores of balance sheet is being audited, our focus will be on some lakhs of rupees disclosures of the NSLE. Likewise, many such disclosures are coming in, and then we are spending more time on trivial nature. And how it compares with the other countries? Are there any disclosures of this magnitude and this nature are stipulated under the acts? Because the problem here is it's a statute. Any non-compliances, non-disclosures have got a wider ramification both on the companies as well as the auditors. Your thoughts and your views on this.
Okay. So, to answer your question, yes, the more information in the balance sheet, it could dilute the quality of the financial statements. A reader could get lost in the numbers, and therefore, what we need is financial statements which are not only useful but readable and understandable, etc. All of it. That's a big project. Before I get into that, on auditor's report, there is a lot of discussion still happening as to whether we should have a long form report just like what you give to C&AG, whether we should have for all audits and file that long form report with MCA or NFRA as the case may be. So then, whatever you may say, there is something in there's much more in a long form report. It doesn't clutter the report to the stakeholder, your shareholder, but other regulators, but it doesn't take away or lessen the auditor's responsibility. Point number one. Point number two is, I am certainly convinced that financial statements today do not serve the purpose for auditors. And if you really see, the analysts get their information and the questions they ask are completely outside the financial statements. How many orders did you get over $1 million? How many new customers you got? How many customers you lost? What is the new lines of business? What is breakdown by this? What's your hiring plan? None of it is there in the financial statements. So unfortunately, we are stuck with historical cost, fair value. We are a prisoner of our own standards. And our financial statements, in my view, do not tell lies, but they also do not tell the truth, which is really useful for the purpose of you to take business decisions. So it's a big project. Unfortunately, the International Accounting Standards Board came up with a project like this, and they ended up by adding one or two line items to the P&L account, which is complete rubbish in my view. And I've said that in a forum where the IASB persons were there and institute had an outreach program. Well, I'm convinced that even I have difficulty in reading and understanding financial statements. And more so, we get lost in the lakhs and crores and all that, in that whole numbers. Whereas I have said this before, that when I go for a blood test, I get the complete lipid profile, let's say. It gives me the range, it tells me whether I'm out of range. It gives me evaluative information. I can judge myself. Do I have diabetes or do I don't have diabetes? What are my problems? In financial statements, it's just lakhs and crores. It doesn't tell you whether you're in range, out of range, nothing. Now at least some ratios have got added. Some aging is there. But otherwise even that was not there. And if we are complaining that this is cluttering, what is being added is more evaluative. Don't you want to know the aging of capital work in progress? Don't you want to know what projects are suspended? Or do you want a simple figure of capital work in progress? Don't you want to know debts over and under 6 months? That over 6 months could be 10 years old. Don't you want to know that? You want to know, no? So that sort of breakdown helps in understanding. Some steps, baby steps are being taken. It may not be there across the world. But I think the little steps are important, but there are other issues which we have had about evergreening, money is borrowed for on behalf of others. Those have all got incorporated into Schedule 3 because of the problems which are peculiar to us. Shell entities are there by dozens even in China. So Chinese is another problem, etc. So I don't think we will be able to solve all the problems, but we need to take up the projects rather than government coming up with a cargo. We as a profession should say auditors should report on these new things, not react to what has been provided by the government. You come up with a model of what financial statements should look like instead of saying that financial statements are cluttered. If that is the view of the institute, then the institute has to come up with what should be financial statements. Sorry, a long answer to a short question. Yeah.
Question, yeah.
Yes.
Please go ahead.
Okay.
No, please go ahead.
Sir, I have a check with me. Paid up capital 1 crore, reserves and surpluses minus 4.48 crores, turnover 2 crores, whether carry is applicable.
Whether?
Carry is applicable. I'll read out again, sir. Paid up capital 1 crore.
What are the nature of the entity? Listed, unlisted, private, not private, what is it?
Sir. Private limited company. Reserves and surplus minus 4.48 crores. Turnover 2 crores.
Turnover 2 crores. Turnover 2 crores, let me just, I don't think, you see this whole thing about reserves and surpluses, the issues of capital is exactly 1 crore?
Yes, sir. Capital is 1 crore.
You'll see here one more. Let me just, I need to refer, sorry. Any other questions?
Sir, we had a question from you.
Yes. My question is regarding, I don't know whether you can hear.
Yeah, go ahead.
My question is regarding clause 19, which is the ability to repay the liabilities for the entity.
I have learned somewhere. I'll look up and tell you if you don't mind.
Yeah. My question is regarding clause 19 about the ability to repay liabilities. Even erstwhile we used to check for going concern, but the tests that we used to conduct were more generic in nature. We used to obtain plans from the management, review whether those plans are reasonable, etc. We used to look at how the numbers are. But looking at the onus is on us to report, or in our view, whether we believe the ability will be there. So anything could be a triggering point, a cash loss, a company's declining revenue, its reliance on one group or another.
Yeah, okay.
So all these things could be points where if there's going to be one major customer who's going to default in the near future, which I may not be aware of at the time of presentation.
Correct. All we are saying is, what is before you, do you believe material uncertainty exists? As on date. If there is nothing, nothing. Nobody is asking you to be a soothsayer in terms of predicting future events. But based on what it is, do you see a
So
problem?
are all these red lights to be red flags to be looked into?
Absolutely.
So
a new
just-
form of view.
I just want to add only 2 lines to that.
Yeah.
I think the undisclosed income or undisclosed asset is not as simple as the question is there in the academy. Because in income tax, when we say undisclosed income, it includes expenditure, as you also pointed out, disallowances, etc., etc. It's not that all the time you have an asset which needs to be brought into the books.
Understood.
That's all. There may be unaccounted transaction which, in fact, many companies do not account for the transaction for the simple reason that if you make an entry in the books of accounts, it initiates penalty under the Income Tax Act. It makes the penalty automatic almost. So in most of situations, it's not accounted. So therefore, I think that the question requires proper understanding of the income tax issues of that. It's not a mere double entry which to make the books of accounts.
No,
That's the
I understand the income tax
The
act has
language
its
employed is
complexities.
unrecorded.
Pardon?
Language employed there is unrecorded.
Correct.
Not undisclosed. Unrecorded is to be recorded. Necessary provisions of expenditures.
So
of tax
essentially what it says
unrecorded
is,
and
if you have,
unrecorded is the language employed there.
it
It
says,
contains a number of penalties, maybe more than the income also. They have to record
possible.
all the things.
All it says is, first is income, first we have to accept, forget the fraudulent income. There is genuine income which is unrecorded, which you have not recorded, but you have surrendered or voluntarily disclosed. Yes, I have not recorded this. Then this question is, fine, now you recorded. You have yourself accepted you have not recorded, right? And you have disclosed that income or surrendered that income. Is there any complexity in that?
I know the person, just only one point. Most of the time when we surrender, we don't surrender like simply like you say that I had unaccounted income or asset and surrendering it. 99% out of 100 times in the income tax act when I surrender, I would say this is not my income, this is not my unaccounted expenditure, everything is fine. Still, I'm giving it up for the purpose of settling a litigation.
That institute has already said,
Yes.
if that you are doing, it is not covered by it. In the guidance note.
Exactly.
Thankfully, in the guidance note, they have provided that. But still, this becomes a subject matter of the litigation with the investigative authorities tomorrow when things go wrong.
Correct.
Yeah, any other questions?
Sir, I have a...
Yeah, Ramamurthy, yeah, you, who else has got?
Yes, Ramanamurthy garu, please go ahead.
Another related point.
Sir, good morning. Very glad to hear you after a long period in person. Question is, see, as an auditor, our report is to shareholders. That is the very intention of the audit process. By virtue of government rights, it is bringing in various stakeholders' expectations into the financial statements, either by way of disclosures or in the audit report.
Correct.
While I understand that the institute is making every effort to see that guidance is given and some kind of balance is made out from the regulatory perspective and the reporting obligation of auditors, don't you think that the quality of financials is getting suffered by clouding the information which are trivial in nature? For example, I tell you, if a crores of balance sheet is being audited, our focus will be on some lakhs of rupees disclosures of the MSME. Likewise, many such disclosures are coming in and then we are spending more time on trivial nature. And how it compares with the other countries? Are there any disclosures of this magnitude and this nature are stipulated under the acts? Because the problem here is it's a statute. Any non-compliances, non-disclosures have got a wider ramification both on the companies as well as the auditors. Your thoughts and your views on this.
Okay. So, to answer your question, yes, the more information in the balance sheet, it could dilute the quality of the financial statements. A reader could get lost in the numbers, and therefore, what we need is financial statements which are not only useful but readable and understandable, etc. All of it. That's a big project. Before I get into that, on the auditor's report, there is a lot of discussion still happening as to whether we should have a long form report just like what you give to C&AG, whether we should have for all audits. and file that long form report with MCA or NFRA as the case may be. So then, whatever you may say, there is something in there's much more in a long form report. It doesn't clutter the report to the stakeholder, your shareholder, but other regulators, but it doesn't take away or lessen the auditor's responsibility. Point number one. Point number two is, I am certainly convinced that financial statements today do not serve the purpose for what it is. And if you really see, the analysts get their information and the questions they ask are completely outside the financial statements. How many orders did you get over $1 million? How many new customers you got? How many customers you lost? What is the new lines of business? What is breakdown by this? What's your hiring plan? None of it is there in the financial statements. So unfortunately, we are stuck with historical cost, fair value. We are a prisoner of our own standards. And our financial statements, in my view, do not tell lies, but they also do not tell the truth, which is really useful for the purpose of you to take business decisions. So it's a big project. Unfortunately, the International Accounting Standards Board came up with a project like this, and they ended up by adding 1 or 2 line items to the P&L account, which is complete rubbish in my view. And I've said that in a forum where the IASB persons were there and the institute had an outreach program. Well, I'm convinced that even I have difficulty in reading and understanding financial statements. And more so, we get lost in the lakhs and crores and all that, in that whole numbers. Whereas I have said this before, that when I go for a blood test, I get the complete lipid profile, let's say. It gives me the range, it tells me whether I'm out of range. It gives me evaluative information. I can judge myself. Do I have diabetes or do I don't have diabetes? What are my problems? In financial statements, it just lakhs and crores. It doesn't tell you whether you're in range, out of range, nothing. Now at least some ratios have got added. Some aging is there. But otherwise even that was not there. And if we are complaining that this is cluttering, what is being added is more evaluative. Don't you want to know the aging of capital work in progress? Don't you want to know what projects are suspended? Or do you want a simple figure of capital work in progress? Don't you want to know debts over and under 6 months? That over 6 months could be 10 years old. Don't you want to know that? You want to know, no? So that sort of breakdown helps in understanding. Some steps, baby steps are being taken. It may not be there across the world. But I think the little steps are important, but there are other issues which we have had about the evergreening, money is borrowed for on behalf of others. Those have all got incorporated into Schedule 3 because of the problems which are peculiar to us. Shell entities are there by dozens even in China. So Chinese is another problem, etc. So I don't think we will be able to solve all the problems, but we need to take up the projects rather than government coming up with a cargo. We as a profession should say auditors should report on these new things, not react to what has been provided by the government. You come up with a model of what financial statements should look like instead of saying that financial statements are cluttered. If that is the view of the institute, then the institute has to come up with what should be financial statements. Sorry, a long answer to a short question. Yeah.
Question, yeah.
Yes.
Please go ahead.
Okay.
No, please go ahead. Next.
Sir, I have a check with me. Paid up capital 1 crore, reserves and surpluses minus 4.48 crores, turnover 2 crores, whether carry is applicable.
Whether?
Carry is applicable. I'll read out again, sir. Paid up capital 1 crore.
What are the nature of the entity? Listed, unlisted, private, not private, what is it?
Sorry. Private limited company. Reserves and surplus minus 4.48 crores. Turnover 2 crores.
Turnover 2 crores. Turnover 2 crores, let me just, I don't think. You see this whole thing about reserves and surpluses, the issues of Capital is exactly 1 crore?
Yes, yes, capital is 1 crore.
You'll see here one. Let me just, I need to refer, sorry. Any other questions?
Sir, we had a question from you.
Yeah.
Yes.
My question is regarding, I don't know whether you can hear.
Yeah, go ahead.
My question is regarding clause 19, which is the ability to repay the liabilities for the entity.
I'll run somewhere. I'll look up and tell you if you don't mind.
Yeah. My question is regarding clause 19 about the ability to repay liabilities. Even erstwhile we used to check for going concern, but the tests that we used to conduct were more generic in nature. We used to obtain plans from the management, review whether those plans are reasonable, etc. We used to look at how the numbers are. But looking at the onus is on us to report, or in our view, whether we believe the ability will be there. So anything could be a triggering point, a cash loss, a company's declining revenue, its reliance on one group or another.
Yeah, okay.
So all these things could be points where if there's going to be one major customer who's going to default in the near future, which I may not be aware of at the time of presentation.
Correct. All we are saying is, what is before you, do you believe material uncertainty exists? As on date. If there is nothing, nothing. Nobody is asking you to be a soothsayer in terms of predicting future events. But based on what it is, do you see a
So
problem?
are all these red lights to be red flags to be looked into?
Absolutely.
So
A
it's
new
just
form of view.
at least the work that we have to do on this.
Listen, you want increased fees or you want increased work or?
Not everyone accepts for increased fees, just for.
No, but the point is, there is no such thing as increased work.
Thank you, Ramesh sir. I understand that all us have been benefited by this. Important points which Ramesh sir touched on, like first time owners amended Schedule 3 and Carry 2020. Increase in risk of attestation, accountability and responsibility of this chartered account fraternity. Investigations are holding up the professionals accountable. Issues like details given by companies to bankers to be and in the carry. Issues like unrecorded income, undisclosed income, how to deal with this. Matters which are prejudicial to the interest of the companies. This, the chartered accounts has to test it. Diversion of funds to be reported. Financial ratios to be a part of notes to accounts. One important thing also is rounding up of the numbers in Schedule 3. Today being Janmashtami, as I have already conveyed you, we worship Lord Krishna at Jagadguru. I thank the Guru here sitting and enlightening us on the Schedule 3 and Kara. After the tea break, which is for 10 minutes, our next Guru, Sri T.S. Ajay sir, who is also in the auditorium, will enlighten us on section 143 to 142. I humbly request Hanumanduru sir, please come on the dais and kindly give a memento to Ramesh sir. The kind blessings and support always to the Thank you so much. Let us join for a tea break.
Hello.
Session on section 143 to section 148A of Income Tax Act 1961. Now may I request second technical session speaker CATS Ajay sir come on to the dais. I request CA Jitendra Patel to present a bouquet to the speaker of the session.
It is my privilege to introduce the speaker of the technical session. T.S. Ajay sir is a chartered accountant in practice since 1986 and is based out of Hyderabad. He is specialized in direct tax laws, consultancy and appeals. He has wide experience in advising corporates on various direct tax issues including joint venture agreements, mergers and amalgamations, acquisition of business, inbound and outbound investments, international tax issues, double taxation avoidance agreement and related tax issues. He has traveled widely outside India on professional assignments. He has been active in the academic front also and has written books on tax laws, published in many technical papers on the above subjects in various forums, meetings, conferences. He was a member of Fiscal Laws Committees of Institute of Chartered Accountants of India, Direct Tax Committee of SIRC of ICI, Direct Tax Committee of AP Tax Bar Association, Managing Committee of International Fiscal Association of AP Chapter, and Managing Committee of Hyderabad Branch of Institute of Chartered Accountants of India. He has been independent director and an audit committee chairman of various companies. So this is a brief profile about technical speaker T.S. Ajay sir. Now it's time to take the technical session by T.S. Ajay sir. Please.